Hi guys, I have received many questions about how I analyze smart money. Smart money analysis is something that every trader has his own style of doing. Today I will be sharing with you my own style of smart money analysis. So in today's video, you will get all the information you need to be able to analyze smart money by your own self without anybody else's calls or helps or tips. Please ensure that you watch this video till the end so that you will get the entire concept about how to analyze smart money and what that data is telling and how you're going to interpret that data. But before we start with the video, I want you to please go ahead and subscribe to this channel. Your subscriptions mean a lot to me. So I also know that my family here is growing. Just let me ask you one question. Who moves the markets? Do we move the market? We retail traders? Do the YouTubers move the markets? Do trainers move the market? Do people who are guiding you to learn trading move the markets? Who moves the markets? We don't move the markets. It's the FIIs, the DIIs, the institutional players that move the market. So big money moves the market, not retail players. Now these big players, the foreign institutional investors, the domestic institutional investors, these players have a lot of money. They have hundreds of thousands of crores which they can invest in the stock market, and so these are the players who can actually move the markets. It is these players that decide whether to take the market up or down. They decide which positions to take in the market. They decide which position they are going to exit in the market. They decide till how long they are going to stay, and while doing all this, they leave a data behind. Now, the analysis of this data is called smart money analysis, and this analysis is done in terms of OI. Now, what is OI? OI is open interest. If you don't know the basis of open interest, if you don't know the definition of open interest, I would recommend you to go to Google and search open interest and read first about what open interest is. When you read about open interest, it is only then that you will understand what open interest is. Smart money analysis helps us to formulate a generalized opinion of what big players are doing in the market, of what kind of positions they are creating in the market. And when you can formulate a general idea, then you have a general idea of which positions you can take in the market. It's not as if you're going to copy them and take positions in the market. No, that is not done. But you get a generalized idea of how things go. Now, the second question that comes up here, and a very important question, should you do trading or should you take your trades based on smart money analysis? A lot of people have this question in their mind. If smart money shows bearishness, should I take a short position? If smart money shows bullishness, should I take a long position? The answer is no, not at all. It is not a trading mechanism. One can only build a general view and take guidance based on the analysis as to which direction the market is favoring. So is the market favoring the long direction, or is it favoring the short one? Or is the market going to stay sideways? Market moves as per supply demand, and you have to take your trades based only on technical analysis. Decisions must be taken only and purely based on technical analysis of support resistances. You should mark your support resistance levels before the market opens. Demand supply zones, because demand supply is the very core of the market. It is demand supply due to which price moves up and down. It is buyers and sellers who move price up and down. And price action, which is the most important thing. Price action is something that you should learn before anything else. So, smart money analysis is not something which is a mechanism to trade. It is not a strategy. It is basically just a general guideline of which direction you should be favoring on that particular day. Now, the next question that arises is, what is the accuracy of smart money analysis? There is no question of accuracy because this is not a strategy at all. As I just said prior, this is not a strategy. This is not something you base your trading decisions upon. So there is no question of it being accurate or least accurate or more accurate or the most accurate. It is quite similar to taking an idea of how the weather is going to be on a particular day. If it's a monsoon season, you're bound to take your umbrella or your raincoat with you when you're walking out of the house. So in a rainy season, you don't base your decision about whether to take an umbrella or not on the TV forecast, right? Or the weather forecast that you get on your phone, right? Smart money analysis is just the same. You do not base your trading decisions on your opinions on the smart money analysis. You just form a general view of what the market might do today, and what you get is a general trend analysis out of the smart money analysis. See, every time it is said that trend is your friend, right? Every time you've heard this, a lot of traders keep saying it. You must have heard it and read it on social media. So it's the right thing. Trend is your friend, because it's only in a trend that you're going to make money. So the last thing you want to do is to trade against the trend. A lot of traders keep losing money because they are fighting with the market. They're going against the trend and they keep losing money because of that. Go to your historic trades and go and study the price action there and see how many of your trades have gone against the trend. Have you been trading against the trend? Have you been trading on impulse against the trend? So if you have been doing that, then such kind of analysis might help you. It might help you psychologically, it might help you mentally. So on a day when you see that there is a strong bearish approach to the market and there are strong bearish positions that big money has taken in the market, then it might keep you from taking long positions on that particular day. Now here I'm talking about intraday, okay? So smart money analysis is just on the basis of intraday. I'm not talking about positional trading, I'm not talking about long-term investing or something like that. This is purely for intraday purposes. Now the next question that comes in is, when should we do smart money analysis? Is it right at the beginning of the market? Should I start and open the page of smart money analysis and start my analysis of smart money right away after the market opens? Or should I be doing it in the mid-morning session, or should I be doing it in the late morning session or the late afternoon session, or when is it exactly? Because the market goes from 9:15 to 3:30 p.m., right? So when am I supposed to analyze the smart money? Now the answer here is that you should let go of the first 45 minutes to 60 minutes of the market. Let the market take a particular direction first, let the market catch a direction, and only then start analyzing the smart money. Why is that? Because the initial 45 to 60 minutes, that is the most volatile period of the market. So what happens is, till about 10 to 10:15 after the market opens, big players, institutional players, are adding on to their positions, they are cutting their positions, or they're adjusting their positions, and this causes a lot of volatility in the market. So based on that, you should let the market run for about 45 to 60 minutes, and only then you should start analyzing smart money. So the best time to analyze smart money is around 10 to 10:15 a.m. Start from there, and then you can take it from there. Start analyzing smart money from around 10 a.m. You can start building your view of the market from then on, because by then you will have a good amount of data with you. From where you will acquire that data, I'm going to show you everything in this video. We will see that on the computer screen. Another question that a lot of you might have in mind is, the moment 10 o'clock happens or the moment 10:15 happens, after that if the market is showing me a good OI build-up at around a certain strike price in the call direction, does that mean that the market is going to go up? Now that is one big mistake that a lot of traders make. Look at smart data analysis or smart money analysis from the seller's perspective, from the option writer's perspective. You're not going to look at this from the option buyer's perspective, okay? A lot of retailers make this mistake of miscalculating or misanalyzing smart money. Wherever they feel that there is a buildup of OI, they feel that that is the position that they should take. It is actually the opposite. Call OI buildup is seen on that day, then you think that you should also be buying calls and the market is going to go long. No. Call buildup data means that a lot of short sellers are sitting on a higher strike price, which means that that particular strike price, wherever you see OI buildup, is actually a strong resistance. So the market is going to face resistance at that level. So you should not make a mistake in interpreting this smart money. Again, let me refresh this for you. If you see that there is an OI buildup at the put side, then it means that a lot of put sellers are sitting at that position. And if a lot of put sellers are sitting in that position, then it means that that strike price is a strong support. It doesn't mean that you go ahead and buy puts and then you short there. You actually look for long positions if you see a higher OI buildup on the put side. We will be looking at the screens now and we will see how you should analyze smart money. Alright, welcome to my screen now. This is the tradingtick.com website. This is the website that I use to analyze smart money in the live market. Now, this website is absolutely free to use and you don't have to pay anything. There are other websites and other sources on which you can pay and get the same data, but in my opinion this data for the kind of trading I do is absolutely and completely sufficient. Now you just have to sign in with your Google account. So as you can see, I'm already signed into it, and after signing in, this is the page where it will take you. Okay, so now let's start with the analysis. I'll show you how I use this website for analysis. Now you can see that there are various options here. One is the futures, the other is the options here. The reports part or the strategy part, I don't use these parts of the website, but just to show you, I'll take you to the reports page. This is where they show us the FII DII data. Now I usually am unable to show you this data because I record the videos immediately post EOD, and my videos are always about the price action analysis of the particular day. So I don't really look at the FII DII data, but if you're interested, you can see how much the DIIs have bought and how much the FIIs have bought. So for example, this is the 1st of April. So it shows that the FIIs have bought for 1910 crores. That was on the 1st of April. Now you can see here how much the DIIs have bought and how much the FIIs have bought. That is on the 31st of March. And you can see here that the lower side it shows the minus symbol, which is the selling symbol. The FII selling here on the 21st of March. So as per the date, it shows you the data for FII and DII buying and selling. Okay, so let's move to the analysis portion now. Now when you point your mouse at the options button, you will be able to see this drop down menu. Now here you see OI data. Okay, so let's go to the OI data first. Now you can see here that it shows us the live button. Now this live button doesn't mean anything at this point because I'm recording this off the market hours. So the market is not working right now. It says that the data is as it was at 3:31 p.m. on the 1st of April 2022. The green is the change in OI in the call options and the red is the change in OI in the put side. In this area it shows the strike prices. It is showing how much is the change in the call data, and the red is the put data here. So what is the change on the put side and what is the change on the call side? And whenever it shows a minus sign, it shows the unwinding. Whenever you see call unwinding, it means that the long positions are being exited. For instance, if you see that at the strike price of 17,400, shows the strike price here. This is the OI change, that is the put OI change at that strike price. So what does it show us? That this is the amount of put OI that has been built up on that particular strike price. So put built up means that a lot of institutions have built up OI at the 17,400 strike price, means that it is a strong support for the market. Now similarly, if we go over to the 18,000 strike price, you can see the strike price here, and now you can see here that this is the call OI change. What does that mean? That call options have been added up at that particular strike price. So what does add up mean? That it means that big players or big money is actually selling a lot of call options at the particular strike price of 18,000. Now whenever someone sells a lot of call options, why would he want to sell call options when he knows that the market is going to go down? Why would you buy a call when you think that the market is going to go up, right? So you think that the market is going to go up, so you buy a call, but institutions and big players are actually selling you those call options because they think that the market is going to go down. So that is when you know that if there is a strong selling of call options at say 18,000 in this case, then you know that wherever the price is at that moment, 18,000 is going to act as a strong resistance. And where is the price in this example, in this scenario? This is the ATM. ATM means at the money. Okay, so what do we see here? Where is the ATM? You can see the strike price at this point, right? So that strike price is around 17,700. So now you know that the 17,700 is where the price is at, and now you can see that the price is going to face strong resistance at the 18,000 and will have a strong support at 17,400. So now you know that the market has a range of between 17,400 and 18,000. So that is how you will analyze the chart in the live market. Now what does this show you? The negative value. You can see here that the value is now negative, okay, below the zero value. Where is the zero value? This is the zero here. and this is the negative side. So what does this show us? There is a call wind up at that particular strike price. Now what is the strike price? It is 17,500. So initially there was a call built up here. Okay, so the call built up was at the 17,500 strike price. But then as the market was trading at 17,700, a lot of sellers of the call option wound up that strike price and they actually built up the put options at that particular strike price. You can see here. So at that time 17,500, you can see that there was a call unwinding, and you can see that at the same strike price there was a put built up. So what does this mean? That all those who had initially had a bearish view of the market, now their view had changed, and when the price was trading at 17,700, at that time they had their view as bullish, so they sold a lot of puts at the 17,500 strike price, which meant that 17,500 was now going to act as a strong support. You can actually open this chart on your laptop and play my video back so that you know what I'm talking about here. And you can see that I have flipped the live switch on. So since the market is closed right now, it doesn't really matter, but in the live market this will be ticking. This will be live data that you will be fed with. It's a pretty fun thing to use. And now let's go ahead with the next options here. Now you don't have to go to the trending OI. Let's go to the call versus put OI. Now this is the OI change. You can see the OI change here. What does this tell us? You can see here that on this axis you get the time 9:15, 10:30. So this is the time that it shows, and this is the OI that it shows. You can see the price here, the price at which Nifty is trading. So now let's try to understand this particular call put OI column here. You can see put build up here. You can see the value given here. The number is 2,22,23,800. And now you can see the calls here. 1,03,20,450 OI. That is the OI built up on that particular day. Whenever you see a big difference between the call and the put OI, now the red line is the put, okay, and the CE, that is the call option, is the green line. Now you can see here that this is a maximum distance that we are seeing between the two on the chart. So what does this show us? That here the market is strongly in a bullish mode. This dotted line is the price line. So as the price is increasing here, the calls and the puts are both increasing. The graphs are going up on the chart. But then what happens is, as price starts to go into a consolidation here, you can see that the call writing here, acceleration kind of starts to reduce. Up to here, the put options writing keeps going strongly upwards. It's an upward journey, whereas the call writing is reducing. It is decelerating, and you can see the sharp fall in call writing here. You can see here at this point at 3 p.m. you can see that there is a vast difference between the put and the calls being written. Okay, again I'll remind you here that you have to understand that this is from the put writers or the call writers perspective. You have to look at this from the call sellers perspective, not from the call buyers perspective. So don't think that there is a lot of put OI here, so that means that a lot of puts are being bought. No, as I explained in the initial part of the video, you can see here that this is the put OI built up, which means that a lot of puts are being written, are being sold, and a less number of calls are being sold. So whenever a big player or whenever institutions sell less amount of calls and they sell more amount of puts, they think that the market is going to go up, because whenever someone sells calls or puts, or whenever someone sells options rather, then his criteria or his idea behind it is to collect all the premium, right? If he's selling calls, does that mean that the market is going to go up? No, that is the buyer's perspective. So from the buyer's perspective, he's going to buy if the market is going to go up, but someone is going to buy puts if the market is going to go down. And it is exactly the opposite for call sellers and put sellers. So for a writer, it is exactly opposite to what it is for a call buyer. Now this range here, it does not really matter what range you select. I don't really pay much attention to the range start and the range end here. That is a fairly wide range. We've selected a range of 2000 points, and that is by default, so I never go back and change that range. And this switch is always on live for me. Obviously we want live data, so it's always important to have the live data there. So you can see that this is the call put OI in relation to the price. So you can see how price goes and how the call writing and the put writing differs at that point. So whenever there is a vast difference between the two, like it is say around this point, you can see here that there is a vast difference between the two, then you know that we are at a definite view of a bullish market. So why would somebody write puts so heavily? Institutions will write puts so heavily because they think that the market is going to go up. They don't want the market to come down, so they will not let the market come down. So if they're not letting the market come down, only then they will write puts, right? And as I have explained in my previous videos also, and even in this video, it is the institutions that buy and sell, due to which the price moves. It is not due to players like us. It is not due to retailers. No matter how rich a retailer is and no matter how many lots he's doing, he just cannot trade the way institutions can trade. And so it is institutional money that moves the market. So if somebody has a long position in the market, if an institution has a long position in the market, they will not allow the market to dip. And so they will write a lot of puts in that scenario, because they know that because of their buying, the market is going to go up. So that is how we can find out the footprint of the large institutions and smart money. Okay, moving ahead, let's go ahead with the next option here. What is the next criteria? It is the CE/PE difference. Right, now let's check this. First thing I want you to understand here is that this difference is PE minus CE. Okay, so let me just write it down here. This is PE minus CE. If the difference is put minus call, then we see that on this day the put writing was much heavier than the call writing, so which means that the market was heavily in a bullish trend. The price is in the black dotted line, right? And so we can see here that as the price starts going up higher and higher, you can see that the difference is always positive. See, this is the price. So whatever the price is, you can see that put call difference is always in the positive. What does this mean? That the entire day, the entire trading session, the market kept going in an upwards trend and the put writing was always heavier than the call writing. So if the put writing is always so much heavier than the call writing, then it means that the market is definitely in a strong uptrend. And then you can always have a view of being bullish on that particular day. I think it's fairly easy to understand. This is nothing but the difference between the put and the call. If the price is going up higher and higher, so if the black line is going higher and higher, and if the difference line is also going higher and higher, then you know that the market is in a strong bullish trend. See here, now at 3 p.m. after 3 p.m. we saw tremendous price action. We saw huge green candles in Nifty on the previous trading session. So you can see here that the put call difference was also increasing. It was also on the rise. So a lot more put options were being sold to retailers. So their big money was taking the market up. So they were selling a lot of put options. And those who were buyers, who were retailers, keep buying those put options only to face losses and exit the positions. So that is how you can analyze it. So even in this area, you can see this, that the market is, the price is going up, right? And even the put call difference is going up, right? And then the market slightly starts to correct, and even the put call difference starts to go down a little bit, but it still stays in the positive. See, this is the lowest point, right? Where is the lowest point? This is the highest point, and you can see that this is the lowest point. Even at the highest point, you can see that 11:15 a.m. this was the put call difference, and even here the value was in the positive. It never went in the negative. So it never happened that more calls were being sold than puts on this particular day. So for the entire day, you can see that the market kept rallying upwards, and so was the difference between the put call. Okay, now let's go to the next one, which is called put call ratio. Again, this thing shows you the same kind of scenario. Now, since the market on the previous session was in an uptrend, you will only be able to see this kind of a chart on my chart analysis right now, but you can always go back and see this, how it looks on different kinds of market scenarios. Okay, you will not see this kind of a linear action on every trading session. You will see that there is a lot of ups and downs within the price, and there are a lot of crossovers between the put call difference as well as on the put call ratio graph also. Okay, so what does this show us? This simply shows us the ratio between the puts and the calls. Now this black line is again the dotted line is the price line. So it shows us how the price is going up or how the price is going down. And here you can see the time. What is the put call ratio at that time? Now a put call ratio is a very simple ratio. You can see here that this is the number of, that is the OI built up for the put side, and this is the OI built up for the call side. Now the put call ratio is calculated on a particular day by dividing the put OI by the call OI. Whenever there is a put call ratio that is above 1 or close to 1, then we have a strongly bullish view of the market. So you can see here that throughout we had a put call ratio that was very close to 1. This is not something on which we base our decisions. So it doesn't mean that if the put call ratio is healthy, then we are going to go ahead and buy calls. It doesn't mean that we have a bullish outlook. This is just a simple way of estimating or just a way of building an opinion as per what the market is showing us on that particular day, but this has to be clubbed with the price action. So all your trading decisions have to be taken based on price action, not based on all this smart money analysis. I don't usually check with the OI overall because it doesn't really mean anything, since we are intraday traders. We are looking only for the top 3 options here: the OI change, the call put difference, and the put call ratio. So I hope that this is clear to you. And one more thing apart from this that I use is here in the futures column, you just have to go to price versus OI. Okay, now here you will see that the black line is the price line. Let me just mark this for you. It will be easier for you to understand. See, this is the price axis. Over here we see the OI, and you can see here how they have colored it. This is the time. As the time goes on, if you can drag the mouse like this, you can drag the pointer like this, you will see here where the OI is and where the price in relation to the OI in the futures is. Why is this important? The price was upwards here, then it kind of consolidated and it slightly dipped here. Okay, and then you can see that as that happened, the OI was stable here throughout. It was not changing, and the price suddenly shot up from here, and you can see that the futures OI was also constant. It was the same. So the open interest here was not changing. Opinion of the smart money was not changing. They still had their positions open. What does that mean? Even the price is going up like this, and if there is a sudden drop from here in the OI, that would mean that they are exiting their bearish positions. From here onwards, that was at around 10:25 AM, you can see that in futures this line here was almost flat. There were no major dips in that. So it wasn't like it went down here, then it went up again, then it went down and went up again. It's not like that. It's almost flat, right? But the price, you can see, was steadily going up. You can see here that price was steadily going up. It was going into a small corrections in between, but then it was steadily rising. And even as the price was rising, there was not much variation in the OI chart. So you can see here that the price took a halt here at around 10:30 AM, and it started to go in a sideways kind of a trend here from here. But then the OI right here also went sideways and the OI was not dropping. In the live market, it shows that if the price is going up but the OI is staying stable, that is, it is also going up, so then the market is, for me, strongly in a bullish sentiment here. So to make you understand this better, let me take you to another screen now. If the price is increasing and the OI is also increasing, then more trades are being taken on the long side. Now what did we just see on the chart there? That the OI was staying constant, right? So it means that it wasn't falling. So the OI built up was being maintained, which means that we were strongly on the long side. We should be looking at the bullish side of the market. Now if the price and OI are decreasing, then the longs are covering their positions, which is also called long unwinding. So it means that the long positions are being exited. All those people in the long position start to exit their positions because the price is going against their positions, right? So there you know that the OI is decreasing. That means that the long positions are being covered there. Okay, now here we will see what happens when the price decreases and the OI increases. What does this mean? If the price is decreasing and the open interest is increasing, that means simple, that more traders are looking at the short side of the market. We know that a short interest is being generated, because when the price is decreasing and when smart money is siding by that price, then it means that they are creating short positions. That is why the price is going down. And lastly, when the price increases and the OI decreases, now here what is happening, that the price is increasing and price starts going against a lot of the smart money or institutions who have those short positions there. So what do? They are in a hurry to cover all the short positions. So that is also called short covering. That means that the market is going to suddenly go up. Why? Because the OI is decreasing. So quickly short positions are being exited. What does OI mean? OI is built up whenever there are a lot of traders who are building positions in that particular direction. So if a lot of shorts are already created and price starts to move against all those short sellers, then all those short sellers will start to cover their positions, and then there is a big short covering rally. So that is the exact relation between the price and the OI. Now let's go back to the screen there. So this is what exactly you should apply on this futures price versus OI screen. I hope this is clear to you now. If not, please go back and read this. I know there is a lot of information in this video, but this is all you need to know about how to analyze smart money. There is no other thing in smart money analysis, and once you get used to this will become second nature to you. Right now, initially it might seem to be a daunting task to read smart money, but eventually you will start getting the hang of it. Within a few days you will start reading smart money like a pro. And this is all updated in the live market. I am showing you in the after hours, but you will see this updating in the live market. So you will see the live tick here. You don't need to look at anything else, future analysis, long versus short. This will just cause paralysis by analysis, because you're analyzing so deeply into it that you will forget to look at price. So I don't want you to be doing that. Forget about premium decay, forget about OI interval wise, forget about everything else, forget about the long and short position, forget everything else. Don't look at the strategy at all. I just want you to understand that you can use this website for your advantage for free, and you can create a general understanding or a general view of the market, and then you can go ahead and take your positions in the market. That does not mean that you're going to completely sidetrack what price action is showing you. Sometimes price action will show you something else and here you will see something else, but then you have to understand that price action is supreme. Okay, another thing that you should be careful about is this data can be pretty jumbled up on expiry days. Sometimes institutions will build this kind of data just to fox or just to deceive retail traders. So you should be wary on expiry days like Thursday, weekly expiries, monthly expiries, or even on days when there are result days like exit poll results or election results, or whenever there is a FM press conference or there is a budget day. On such event days, this kind of data analysis will not help you. So don't at all rely upon such kind of analysis, because on that day OI build-up is so violent that people are exiting positions left, right and center, and they're creating new positions every now and then. So there the data is absolutely unreliable. Friday to Wednesday, on days when there is no particular news in the market or there is no particular event in the market, such data analysis can be pretty useful and it will be pretty advantageous to you also. So as you saw, I've made it very easy for you to understand, and this is all that you need to analyze smart money. Of course, this is my method. All in all, in general, this is the crux of analyzing smart money. And again, remember this point that none of my trading decisions are based on smart money. My trading decisions are entirely based on price action analysis and candlestick formations and support resistances and supply demand zones. So this is all that I look for. I look for the general market structure. I look for the exact pinpointed locations at which I want to trade. I see what kind of price action both Nifty and Bank Nifty are showing at that particular level, and only then I will punch orders. I do not base my trading on smart money analysis. Smart money analysis is something that I do only to have a generalized idea of how the market is acting on that particular day. What is the general mood of the market? What is the market showing me, so that I don't exactly go ahead and trade opposite to the market. See, a lot of the times we can save our SLs by trading with the direction, with the market. So wherever the market is going, wherever the tide is, in that direction you should put your trades. So if you can do that, and if you can stop fighting with the trend, then most of the times your SL will be saved. So this was my video for you today. I hope you have liked it. If you have liked it, please hit the like button and subscribe to this channel, and also hit the bell icon so you don't miss any updates for any videos that I post in the future. Please leave your comments in the comment section below, and please share my channel with your friends and family so it helps the channel to grow more, and I can also reach out to more and more aspiring traders. I'll see you in the next one. Thank you.